Hi, my name's Allan Madan. I'm a chartered accountant and a tax expert in the Mississauga and Toronto regions of Ontario, Canada. Today's short video is about the small business deduction and how it helps small business owners in Canada save taxes. By way of background, why do individuals want to incorporate in the first place? The reason being is that the personal tax rate on business income is very high. If you are an individual in the highest income tax bracket, then you would be paying 46.4% on the business income that you earned. As a corporation, the tax is significantly less as compared to an individual. So what is the small business deduction? The small business deduction is a deduction available to corporations on active business income that reduces the general corporate income tax rate for corporations from 32% to 16.5%. Let's break those components down a bit further so we can truly understand what the small business deduction is. The first question we should answer is, what types of corporations qualify for the small business deduction? It's not enough just to be a small business to qualify for the small business deduction. The business must be incorporated, and it must be a Canadian-controlled private corporation in order to qualify. What that means is that 50% plus one of the voting share capital of the corporation must be owned by Canadian residents. So if you have a non-resident shareholder who owns more than 50% of the shares of the corporation, then that corporation won't qualify for the small business deduction and won't receive the preferential tax rate of only 16.5%. The second thing that we need to examine is what types of income qualify for the small business deduction. Even if you're a Canadian-controlled private corporation, you still may not qualify, or the income that you earn may not qualify for the small business deduction. So the types of income that qualify for the small business deduction is active business income. That's simply income earned from a business. It excludes investment income, such as interest and capital gains and rental income from real estate investments. Now that you know what types of corporations qualify and what types of income qualify for the small business deduction, how do you take advantage of it? The first $500,000 in profit, that's revenue minus expenses, is allowable for the small business deduction. To take advantage of it, when you complete your corporate income tax return, or when your accountant does, have them claim the small business deduction on the corporate tax return in order to reduce your corporation's overall tax rate to only 16.5%. If you are a very profitable business and have profits in excess of $500,000, the excess will be taxed at a rate of approximately 32%. So it's a good idea to bonus down, that is, declare a bonus by the corporation payable to you, the owner-manager, and have that bonus paid within 180 days of year end to reduce the income of the corporation to $500,000. That will avoid double tax. There are other tax strategies such as the use of GRIP and dividends, but that's beyond the scope of this video. I hope you found some benefit from the small business deduction video, and for more information on tax tips, I encourage you to visit my website, http://madanca.com, which is shown at the bottom of this video, and to get access to your free report on how to beat the tax man, please look at the URL at the end of this video. Thanks for watching.